Bazaar, the markets are now giving up a little more of their strength, especially at the mid-cap end. And the bank Nifty is about flattish, just a shade of red. The advance declines are still in favour of advances. Well, that's the near-term position. But let's indulge in some slightly longer-term correlations for the market and the economy. UTI AMC has come out with a very interesting report, if you can call it a note, which indicates that probably there's no connection at all between economic growth and market returns. And the key factors for investors to track are actually underlying cash flows of individual companies, sustainable return ratios, the price one pays to acquire the business, and not really macros like GDP. Well, that's a strong statement. Vetri Subramaniam, Group President and Head of Equity at UTI AMC, as well as Sachin Trivedi, the Senior VP and author of this blog, are joining in. Gentlemen, thank you very much for joining us. Sachin, well, since you are the author of the report, to you first. This is a kind of a damning statement on macros. You really don't give a damn if this year GDP growth actually turns out to be below 7%, is it?
No. So thank you, first of all, for hosting us. So I'll put it this way, is that what we are arguing in this entire note is that high high GDP growth is not just the sufficient condition for generating superior return. This is contrary to the common perception that you need high growth to generate higher return in the market. Now, to make this point clear, we have put certain data points with respect to various markets, and we have also put data for India, China, US and Japan in this, and this is all in USD terms. And we have put up a 10-year as well as 7-year data points, wherein the observation is very clear that both the India and the Chinese market have generated superior economic growth, but the market return have been quite muted when we compare this to US and Japan, where US-Japan economic growth has been quite muted, but the market return generation has been quite superior in this case. Now, on this subject, there has been a lot of study been done, and in our report we have quoted study done by Professor Reiter, Professor Siegel, and both these gentlemen have found that there is actually a negative correlation. Of course, we have laid down
negative correlation between growth and markets.
Yes. So Professor Reiter has done this study right from early 1900 to 2011, and Mr. Siegel, Professor Siegel has done the studies for 27 years. In fact, in our case also, what we have done is we have done the study from 1990 till 2017 for Indian market, and we just find a 0.2% correlation. Which is where, and then we have given further arguments for why this could be the case. Right, and one of the factor for this outcome could be is basically what is the price that we pay, or what is the PE that we pay at the beginning of the year, right, at the time of investment. And generally, because market is forward-looking in nature and it tends to discount lots of earning growth in future, which is where there is disconnect that which is where you find that there is earning growth, there is GDP growth, but then you don't make sufficient return in the market. Then there are a host of other issues that we have pointed out, but one or two other issues that I would want to point out here is that generally if the objective of the management is just a growth, this growth as well can be achieved by putting in capital or investing in projects which is generating return below cost of capital, which is where you find this mismatch that you achieve growth, you achieve economic growth, but you don't achieve the return which is expected by the investors.
Okay, we got that. So it's very interesting, the point that you're making. In fact, our production team has helpfully put out the graphs as well. Between 2008 and 2017, the Chinese market, the China GDP went up 13%, while the market was down 2%. So that graph will come up for you. And India, 7.5% GDP, market didn't do much, just a 0.5% gain. Vetri, hi, good morning. So it's established, right, that there's no correlation between GDP and the markets. But what about GDP and earnings? Have you guys done any study on what the correlation there is and what an investor could extrapolate from it?
Yeah, sure. Thanks, Sonia. Yeah, I think, one point I would make is that the purpose of putting out reports like this is just to stimulate people to think a little bit more deeper about these issues, because sometimes I think we make very simplistic arguments, and those simplistic arguments can be downright misleading. So we wanted to just show the flavor that it's not a very straightforward equation. Now, you ask a very interesting question, Sonia, which is about the correlation between GDP and earnings. Again, the data on this is actually quite mixed. And when you look at the data as to why this is mixed, there are 2 or 3 factors which start to kick in. First, I would say at some level refers to the productivity of capital, because you can get growth in GDP, but again, just to put it in very simple, easy to understand terms, if the growth in GDP is being created by investing capital at a return which is lower than cost of capital, you are not actually creating any value in this for the owner of the enterprise or the provider of the capital, and therefore it will not show up in earnings. A second point that I'll make, and this is slightly more nuanced, is that we need to distinguish between the earnings that companies report in aggregate, and as shareholders, what we are most concerned with is not aggregate profits, but profit per share, right? I'll give you a simple example. You take a company like, HDFC Bank, and you look at their 15-year and 20-year performance. The gap between profit growth and EPS growth is almost 5% a year over a 15-year and a 20-year period. So you've got 29% profit growth over a 15-year period, but EPS growth is only 24%, essentially reflecting the fact that more capital is having to be put to work, and therefore per share growth is much lower. And remember, it is per share growth which feeds into stock price returns and index returns, not aggregate profit growth. So that is why there is a wedge between GDP growth and the outcome in terms of equity returns, because the effect of capital dilution has to get captured in this equation.
Okay. But Vetri, in the past few years, we have seen that there is less connect even between earnings growth and market growth. The last 5 years are witness to an earnings famine, but markets have done fine.
And absolutely, Lata, and that is where the challenges of this kind of analysis, and what we want to therefore highlight, that investing on this premise is a little bit challenging, because markets are always forward looking, and therefore the question when we do this kind of analysis point to point is that we are not taking into account how much the market has already factored in by way of expectations. And therefore, in a way, I would say one very simple thing that one should take away from reading this report is that eventually investing is all about the actual outcomes in terms of earnings per share being superior to your expectations. If it is already factored in, then you cannot generate returns out of that. And that is why valuations matter.
Okay, so GDP has no correlation with the market, GDP has no correlation with earnings, market has no correlation with earnings. Just do your own study on individual companies and, look at strong fundamentals. But let's drill it down to some sectors, right? Sachin, in your blog, you've said that in theory, technology contributes to the growth of an economy. That's what we all think. But in reality, the benefit from changes in technology accrue only to a consumer and not to a shareholder. Can you elaborate this in the form of sectors and to make it easier for our viewers to understand?
Yeah, so when we look at factor of production, it's land, labor, capital, and if we want to bring in technology into this part of it also. So almost 2 decades back, Warren Buffett has also argued about the same fact, and he's pointed out that change in technology, unless the corporates can monopolize the technology, change in technology, the benefit of it over a period of time goes back to the consumer and to the economy and not to the corporate. Wherein he's pointed out certain industries like radio manufacturer, television manufacturer, aircraft manufacturers. And whole host of other examples have been given about this fact. So we've tried to drill down and look into Indian market also, and we found one very interesting observation is that even within telecom service providers, where we found that in last 10 years, if we were to just look at this pack, nominal GDP growth in last 10 years has been around 13%, whereas the telecom service provider market cap growth has been around negative, around 2%. versus just even the operating profit growth for this sector has been just 5%. So this is in last 10 years we have seen a jump from 2G to 3G to now 4G, and in future maybe 5G. But what this data is indicating to us is that the sector, the benefit of this transition has gone to end consumer, where we are all enjoying data at much lower pricing. But effectively the companies which are implementing this are actually struggling to show performance. That's what the argument that we've been put based on the observation that we've got.
Okay. Well, we can't have such stock market experts and not ask you something about the here and the now. Vitri, what is your sense about the state of the markets now? Is it looking like it has discounted too much by way of earnings growth? Are you comfortable buying at current levels?
So if you look at the valuations, Lata, on a trailing basis, they are significantly expensive, quite expensive. It's in the upper reaches of valuations on a historical basis. But, that's also slightly misleading, because we know for a fact that last year the financials had a very disproportionate hit coming through, below their operating profit line. And we do expect that that will normalize in FY20. So, the consensus earnings growth expectations for the Nifty in FY20 are almost something like about 24-25%. I think there is a decent probability that a lot of this will come through, because the delta is coming from 4 or 5 large institutions which are swinging dramatically from last year. And therefore, when you look at forward earnings, it's expensive, but not as expensive as is suggested by the trailing earnings. So, while I would typically prefer to look at trailing, I think it also gives a little bit of a misleading picture today. So I'd say we are in territory where we are certainly trading above average valuations, not as egregious as suggested by the trailing valuation. Okay. But still a time to tread careful, because it's certainly not trading cheap.
Okay, well, that's about financials for sure, and that's almost a herd trade now, consensus trade now, financials, especially banks. Just a word more on the kind of slowdown we have seen, the autos, and now, ACC cement numbers, one would have thought that, there at least we should not have seen the slowdown. But again, the revenues and the volumes tell you the same story. How will you parse this in your selection of stocks?
Well, we don't react to too much of this in terms of trying to readjust portfolios for short-term factors, Lata. But that said, I think clearly the events that happened in the last quarter of 2018, which are sort of transmitted through the lending system, through the NBFCs, through the mutual fund, means that quantum of credit available is reduced. The price at which that credit is available has gone up, and we are certainly seeing a negative impact of this filtering through the economy. It's visible in the performance of the high frequency indicators that we get of interest rate sensitive products like automobiles, consumer durables, etc. So I think unfortunately that, combined with a seasonal slowdown which is normally visible as you head into an election, means that the economy is once again going through a soft patch. And this soft patch is actually the third consecutive soft patch in the period of the last 3 years. Right? So we had a slowdown somewhere around the demon time. We had a slowdown around the GST time. Surprisingly, through this period, consumption trends did not really suffer very dramatically. But this time around, we are seeing consumption start to suffer. I think there will be a bit of a positive seasonal uptick post-election. But I think the impact of what's happened in the last quarter of 2018 is going to have a restraining influence on that pickup.
Okay, and we don't even know whether that has fully played out, going by the problems in the NBFCs. Take your point, Sachin and Vitri. Thank you very much for joining us with some of those interesting correlations that you have brought out. Maybe this September 5th, we are going to see yet another piece from both of you, maybe, on what are the learnings from the stock market. I still remember your 2013 piece, Vitri. Thank you.